Today, I'm diving into a topic that's got the world holding its breath: potential skyrocketing oil prices due to tensions in the Strait of Hormuz. Grab your coffee, let's break this down. First up, why is the Strait of Hormuz such a big deal? Well, it's simple. It's the world's most critical oil transit choke point. This narrow waterway links the Persian Gulf to the Arabian Sea and is responsible for the daily transport of 21% of global petroleum consumption. That's around 21 million barrels of oil per day. So any disruption here could send shockwaves through the global oil market. Currently, tensions between Israel and Iran are raising fears of an Iranian blockade of the strait. If this happens, experts say oil prices could spike to a staggering $350 per barrel. Let's put that in perspective. The highest oil price ever recorded was nearly $150 per barrel back in 2008. Yeah, we're talking about potentially more than double that. Now, you might be wondering, how likely is this blockade? Most analysts agree that it's a low probability event. The oil market doesn't currently anticipate a supply shock, and the consensus is that the chance of an Iranian blockade is remote. But let's not get too comfortable yet. If the strait were blocked, the impact would be massive. Countries like Saudi Arabia and the UAE have pipelines that can bypass the strait, but their capacity isn't enough to offset a complete blockade. The US Energy Information Administration estimates only 3.5 million barrels per day of unused pipeline capacity could be available to bypass the Strait of Hormuz, which is far below the 21 million barrels that pass through it daily. Bjarne Schildrup, chief commodities analyst at SE Bank, suggests that oil prices could spike to $350 per barrel if the strait were closed for an extended period. However, he believes this scenario is unlikely and any price spike would be temporary. Oil prices would eventually fall below $200 per barrel as the global economy adjusts. Warren Patterson, head of commodities strategy at ING Bank, also warns of the potential for record-high oil prices if a significant disruption occurs. A supply cut from the Strait of Hormuz could jeopardize 14 million barrels per day from Middle Eastern producers, pushing prices past the 2008 record. Despite these dire predictions, most analysts remain skeptical about an actual blockade. It's unclear whether the US would allow such an event, especially during an election year. Plus, would Iran really cut off its own primary source of international income? Seems unlikely. So, for now, the possibility of a major disruption in the Strait of Hormuz remains speculative. Market participants are waiting for concrete evidence of a worsening situation before reacting.